Hey everybody, Preston Brent here for our weekly roundup. This is for the trading week holiday long ending March 30th, 2018. I hope everybody's having a good holiday weekend, Easter weekend. Most of the markets were closed on Friday, and then some are going to be closed on Monday. I think we still have for Easter Monday, Australian, German, Hong Kong markets, the UK, they're still going to be closed on Monday. But Friday was closed for most markets. And we limped into the week last week, which ended Q1 slightly up. Although we did see for the first quarter, the Dow was down about 2.5%, S&P was down 1.2%, NASDAQ finished up 2.3%. Now that's for the first quarter. That's not from the highs. Obviously, if we look at where we are off the highs, we're down, 7 or 8% off the highs. In fact, the S&P is in the red for the year. And as I go through these charts, I'll show you, excuse me, I'll show you what I'm talking about. Treasury yields are still down a little bit. They're down about 2.74%. But as I said, I think last weekend in our weekly market watch for our members, this is all about the three T's as we go into 2018 and the risk that's there. It's a completely different market. The environment has shifted from 2017. And by the three T's, I mean tariffs, tightening, and technology. Tariffs, obviously, with, will Trump enact more or will he do less? And how will China play it? And how will other countries play it? My guess is it's more negotiating ploy, but the markets always react to the first Twitter that hits the inbox in the morning hours, and that's generally how price action moves on a near-term basis. I believe longer term it'll work itself all out very nicely. The other one is tightening, and we're seeing the interest rate. Last week or so, the the rates were up, but that was expected. 25 basis point rate hike. Now the big the hurdle is: are there only going to be two more rate hikes for this year, or will there be three? I've seen some analysts say there could be four. So you don't want to get too far ahead of yourself, but the market's going to be watching it. A lot of economic data coming out, looking for inflationary data or lack thereof, as how the markets are going to be interpreting, is the inflation going to be there or not? And just by judging by the longer end of the yield curve in the Treasury debt market, more specifically the bonds, 30-year bonds, interest rates are coming in. Treasury 10-year interest rates coming in a little bit, but the 2-year is moving up. So that's moving our yield curve down closer and closer to the zero line. We're around 50 basis points or so, so that's unusually low. We got to keep our eye on that. And then the third T is technology. And, that's probably, the front and center, the poster boy for a tech lower move was Facebook, obviously, with all the issues that's coming up with Facebook right now. But we also have a few others out there. Possible more regulatory risk, not only from Facebook, because Zuckerberg's got to go in front of Congress, but we've got Amazon, Google, a number of companies that can face more regulatory risk. And all we know from history statistically is when a company is targeted for more regulation, that company's share price tends to be affected to the downside. So the other thing with technology that I noted, which is really interesting, tech right now accounts for about 25% of the entire weighted value of the S&P index. Okay, 25%. Now in the dot-com bubble, it was around 29, 30%, but now it's only 25%, but it's still very, very high. And if you take the top tech companies, take the top five, let's say, Apple, Microsoft, Amazon, Google, and Facebook, they account for over 14.4% of the S&P index. Amazing. In fact, those five stocks have a higher weighting to the S&P than the entire industrial sector. It's really amazing. So that shows how the S&P can be kicked around a little bit as technology gets, taken to the woodshed, or continues to be taken to the woodshed. I think it's going to create some buying opportunities. I personally tend to like Microsoft a little bit better than some of the other techs, because they're not driven as much by certain revenue avenues as, say, Google or Facebook, where they need a lot of ad share, where Microsoft does not. advertising shares. So I tend to think that Amazon, they got punished as much. I'm sorry, Microsoft got punished as much as Amazon, Apple, Facebook, pretty much all the other techs. But I think Microsoft will probably weather it much better than the others. So this is kind of where I'm looking at right now as we go into this year here. And volatility is up double from where we've averaged in 2017. Right now we're sitting around 20. So let's take a look at the charts just so that I can kind of give you guys a perspective of my view of where we are. If we look at the E-mini S&P 500 futures, you can see on this screen, I got a lot going on here, but each line has a purpose. Each color has a purpose on my charts. And if we look at this and we keep it really simple for now, at a very high level, you can see these pivot highs right here. We could not get above that prior pivot high when we hit this level right here. And that was our early warning signal that, we're still going to come back down and test some of these lows down here. Now, we haven't made it down here yet, but if you look at where we've closed, right, our closing level and our closing range was right there. Now, these long tails on the candles just show the intraday range, where markets always tend to move lower. And this was catapulted by a major dislocation in the volatility market. So you could probably say this range right here was more reflective of a closing low than the intraday low. And if you look, this is kind of what's been holding us up right here, right in that area there. We've been held up by the closing low, by the closing lows right there. So if I were to switch this to a line chart, it would look like we're just actually testing the lows. You can see the 50 EMA sitting right there. So that is our bogey to the upside. We got that psychological barrier right there, which is the 2018 open price at 26.75. And you can also see on the screen, let me just clear everything up just a bit, kind of erase this so that you can kind of see what the heck I'm talking about. This counter move down, this second one down, reached an apex of about 10.16%. So we did officially, down in that level right there, enter back into a correction territory. Now, some technical folks say we stay in a correction until we go back and take out the all-time highs, but I don't really necessarily believe that. We're in a correction mode for sure, but we're up slightly, not much, but up slightly from the all-time highs up here at 28.7850. Now, the lows that we made earlier in the year took us down 12.14%. So we're still down in this area here, and we're still very weak. The markets tend to show a lot of weakness here, and any bounce that we're getting right now off of this chart, to me, is more subject to a downside move than an upside move, at least at this point in time. The other thing I'm going to show you here, as I blow the screen up just a little bit, and I'm leaving my indicators on the screen, so hopefully it'll come in better for you. You can see this line right here, that's the 200 EMA. And you can see as I draw this, it's almost gone flat, all right? So when you have a 200 EMA that's flat, and you have a 50 EMA that's moving in that direction right there, and we're in the lower quartile, third of this range between the two, right? So we're in this range. The overall market is in what I call a yellow flag condition, all right? So we're in this yellow flag condition right now. We're not green and we're not red. As long as this area holds here, we are okay for now. It just shows the market is trying to work itself out to determine a directional bias as we move forward. Now, we've got a couple of key things coming up that will then break either this upside target or this downside target. The primary one is earnings. It seems like we just finished Q4 earnings. We're going into Q1 earnings here in another week and a half, probably another 10 days or so. The forecast for earnings is to be about 17% year over year for earnings per share. That will then move the markets higher, okay? That is the forecast. As I said before, there are only two things that move stock price longer term. They'll always find their equilibrium and move in this directional bias. Number one, earnings per share. You have increasing earnings per share that'll have a tendency to move prices higher. But then the counterbalancing force is interest rates. Those two things, earnings per share and interest rates. Right now, interest rates are moving down slightly. That'll continue to push some money back into the equity market. When interest rates start to move higher, then U.S. Treasury debt is going to start competing with equity for risk-free money or lower risk money, because big money that moves these markets are looking for the highest return for the lowest risk. And when they do their allocation, their money allocation, whether it's a certain percentage into debt versus equity at a very simple level, the more the debt market starts to go up in interest rates, the more it's going to start competing with the equity market for an annualized overall return. Okay. So that's kind of, and you'll see that reflected a lot in some of these things. Now, the other thing that's happened is with these passive index funds that control about 25 or 30% of the money invested, they tend to take it on the shorts. I mean, they get hurt really bad when you have a mass fallover like we've had in Q1 with the tech shares. But this is kind of what I'm looking at right here, guys. So we're going to be in between this area up here and then this area down here. All right, so we're kind of in this middle zone here. All right, now what I did with our members on a recent session, I think on Wednesday during the work week, I took us down into a 2-hour chart. All right, so let me do this. What I'm gonna do is I'm gonna move us down to a 2-hour chart, and we're spending some time on the E-minis just because I don't care what stock you own, what equity you're playing with. If the markets roll over, then what you own is going to go down with everything else. It may not go down with the same velocity or the same nature, but it will go down. Correlations tend to go higher when markets fall. But if I take it to a 2-hour chart, that's why it's very important that you understand what the overall market environment is like, what the regime is like before you start laying on money here. So now you can see here this really tight. Now each bar is a 2-hour bar, right? Okay, so that just gives you a little bit of time perspective. So we're going all the way back to the 27th, okay? And then if we look at almost for the entire week, okay, you can see it's just been a very up-down market. Finally, we traced out of that as we went through close on this Friday. Okay, we traced out of it, meaning we were in this range right here. And we were down in this range right here. Okay, and we finally broke out of it. And then you can see here that we did the very next bar. We came right back down and tested it. We made a high up in this area here, and now we're sitting right in that area there. So the big key for me is, are we going back down below 26.27 and end up back in this chop again, or is 26.27, is this number here going to hold and provide support and give us lift as we kind of edge up into earnings for Q1? Again, they're forecasted to come in very strong. We shall see whether they do or do not. Okay, whether they come in strong or not. So the other thing that I did is, let me just turn off some of my indicators here. Let me just get that set up like that. Now, I also, on a 2-hour chart, put in the lows that we made back on March 23rd, not February 5th, but the lows that we made on the 23rd. And then the highs that we came back and made on the 27th going into this week. And then I ran some fibs, and I did these fib retracements here. And you can see that a typical retracement is 50% of a big move. And that put us at 26.32. And that is what I think I'm going to be watching for support or resistance as we come in. Now I said 26.27. But if I were to technically look at it, I would say 26.32. If we blow back below that and fall below the 61 level again, we're going to be back down in this chop. So I'm going to be watching this very, very closely to see where we go in these markets. Okay. Now, if we look at NASDAQ, and let's take it back out to a daily here. In fact, let me go back to the E-minis and just go back to a daily real quick. One final note here. We're going to be in this chop until one of two things occurs, okay? and you cannot predict it. But we've got our 2018 lows, and then we've got this point right here. We took out that key pivot point right there because we were making higher highs, and that was our first higher low, but then we could not make a new higher high. So that roll over there, I was looking for this level to hold. It did not hold. You can see on that huge down day, we came down and actually closed right on that level. And then we didn't move. But then the very next day, we blew below it right there. So this level right here, which is at that level I point out earlier, right? Is going to be a resistance level for us on this daily chart. We need to get elevation up above there. If we roll back over, then I suspect the odds do favor us coming back to test this 25, 29 area. All right, that's where the odds are, and they're still at that point right now. So it would give us a pattern that would look something like this. And it just kind of sucks everybody in. But what would happen is as our pattern would be this down move, right? We come up and we may hold up in this level here, or maybe even a little bit higher, and then we come back down and then we make another lower low right here. So we've got that high point, we make another lower high and another lower high, and we've got this lower low and then another lower low here, right? And that would give us that channel just like that as I draw these things out on the chart. So is this going to happen? Well, who the hell knows? But we're going to follow the price action and take it a day at a time, looking at the fractal nature of the market, going inside out from the 15-minute, 2-hour, and then daily, and then even out to the weekly. Okay, I do believe the markets are still poised to move higher, but we're in this overall chop correction type of mode here as markets do some more reallocation. We also saw some of that reallocation at the end of Q1 as profit taking was occurring in some of the tech sector. Some of the good stocks were sold off with some of the ones that were probably overvalued. And now we're coming back down again. The PE ratio, the forward PE ratio of the S&P is still over 16. It's about 16.6, 16.6. It was up over 18 until we had the big move down. So we're around 16.6. The average is a 5-year average is about 16.4. So we're getting closer to fairly valued. Although there's some sectors like tech that might be slightly overvalued. But I will point out that the earnings coming out this Q1 for tech are forecasted to come in slightly higher than the rest. I think the tech is forecasted to grow earnings per share by about 22% for Q1 versus around 17% for the S&P in general. Okay, so that'll provide some support there. If we come into NASDAQ and we look at the daily chart of NASDAQ, you can see right here, the only thing that's given me a little bit of guidance that the markets are just in an overall correction chop instead of turning into a bear market is the fact that we made higher highs right here. Okay, when you make higher highs in one of the indexes like we did right here from here, you don't make higher highs in a bear market. You don't make higher highs in a market transition. You typically make lower highs. Now, remember, this could play itself out. It doesn't play itself out in 1 week or sometimes even a month. It may take 4 to 6 months to play itself out. I am still on record as calling for a bear market the end of 2018 or the beginnings of a bear market in 2018 going into 2019, sometime by the summer of 2019. I still believe that. I believe the markets are going to pull back anywhere from 35 to 45%. But right now, I still think we've got some more upside left in the markets. But if we look at NASDAQ, you can see we're below the 50 EMA, below the 200 EMA. So again, a yellow flag for the NASDAQ. And then if we look at the Russell came closest to making new all-time highs. The NASDAQ was the only one that did it. But if we look at the daily chart of the Russell, you can see here we almost made new all-time highs. That was back on March 13th, and then we gave it all up. We're between the 50 and the 200 on the Russell. But the good thing about the Russell is we're making higher highs and higher lows. Okay, unlike the Dow or the S&P, which failed to make a higher high and it rolled over. We've got lows, higher lows, and right now we're trying to form a higher low, highs and higher highs. So we've got this kind of um, thing going on right here, a very wide channel, which means we've got a lot of vol and chop in the channel. It's not very tight, but we're still making higher highs and higher lows. Now, again, should this break down, we're going to see it right in the charts. We're going to see the breakdown occur in the charts here. And then what will happen is, we've got this interim prior pivot low right there, and then we're sitting here. So if we come in and we roll over and we take out that prior pivot low there, right around 1500 roughly, and we come back down here, then that negates that, and it negates these higher highs, and now we're going to be in a chop mode. But right now, we're still in higher highs and higher lows on the Russell. And this is small cap, mid cap, so that's kind of a good thing, right? It shows there is money seeking some risk in the market. So this is something that I want to watch very closely. And then, of course, if we got to the Dow is the one that's just been really hurt the most. And again, if we look at the Dow futures, I mean, it's just, there's no prettiness about this one at all. We didn't even come up and make a higher high. In fact, you could probably say, and let me just move this out right here like this on this one. You may be able to see this pattern right here. And maybe this will give us a little bit of a sense of the bottoming of the market here. But if I were to draw almost like, well, let's go like this right here. It's not quite a head and shoulders pattern, right? It really isn't. Some people try and do that, but it isn't. But what we do have here, when I put this together and draw it out, is that we've got a low here. We have a higher high here, and we got a higher low there. But then what happened is we could not make a higher high here. So that was the first indication of a fail. And you can see on this 50 EMA, we could not have follow through. So boom, up comes the yellow flag, right there. And then we come back below the 50 EMA, I mean the opening price of the year for the Dow futures. And now you can see the 200 EMA is almost ready to go flat. So just like all the others, we got the 50 EMA declining. We got a flat 200 EMA. That is more bearish than bullish, hence a yellow flag. Now, if we move below the 200 EMA, then we move into a red flag condition, and then all bets are off as to where we're going to go. This could get a little bit worse. I'm believing right now, near term, as everything is timed out as we go into earnings season, that earnings will come through and it'll give the markets a little bit more oomph. But we shall see, right? I mean, we'll see. If we look at volatility, and we come over here, and let me just find it right here. We finished the week almost around 20, right? We are in the yellow zone, in the upper half of the percentile of the yellow zone, right? And as I said, when we got way up here into the red zone, didn't turn it into a black swan kind of thing, but pretty damn close up here above 50 in the VIX. You can see when this happens, volatility is very sensitive to downward movement. And that means that any small move, let's say we move down 10 points. In 2017, if we move down 10 points, vol may have moved maybe 50 cents, maybe 50 basis points of a Vega move, or maybe 1 Vega point move. But now if we move down 10 points, you're going to see vol move up more than that. It'll move up probably 50% greater than 2017, because vol is very sensitive now to any downward move. People are very sensitive. Investors are very sensitive. So the first sense of a move down lower, people are more apt to go out and buy out of the money puts. And that's going to drive up volatility. So that's why generally when you have an event like this, it tends to push volatility into the yellow zone and keep us there for about 3 to 4 months at a time. All right. And this is kind of where we're sitting right now, which is exactly what I said. Okay. And you can see the 50 EMA, which is the red line, is a rising line. We're getting separation between the 50 EMA and the 200 EMA, right? And we're moving up in the vol. So that's kind of where we're sitting right now in volatility. Treasuries, well, look at the bond market. The bond market is moving up dramatically. Look at this. So that means interest rates are moving down. Now, why is that? Even with the talk of 3 rate hikes, bonds are moving up. It's a vote that the bond market, which is a lot bigger than the equity market, by the way. The debt market is much, much bigger. You tend to want to follow the debt market and interest rates and credit spreads more just to get an idea of where money is going to flow. And right now you can see money is still flowing in the further end of the yield curve. Interest rates are moving higher. I'm sorry, lower, and the bond market is moving higher. On the shorter end of the yield curve, when you get down to like the 2-year, then you're going to see interest rates moving up. And that compresses the yield curve, which puts us in a position of being closer to some kind of a recessionary event. All right, that remember, if you guys remember from last year, that was one of the big worries that money had, was that the Feds will muck it up and roll us into a recession. So that's a little bit about where we're sitting here. And if we look at the 10-year, let's look at the 10-year interest rates. They're coming off the highs. You know, we hit the highs here on February 21st of 2.94, 294 basis points. And we finished the week at 274 basis points. So we're 20 basis points lower interest rate rise than we were before. Why? Because the markets just don't believe inflation is coming down the path. And as long as there's really no signs of inflation and these knuckleheads keep raising the rates, then because they're afraid they're going to be behind the 8 ball, that could inadvertently push the market into a recession. So I don't see that fear near term, but if we take it out to the end of the summer to the fall time of this year, that could be more of a reality than just a theory. All right. If we look at currencies, the dollar, again, it's confounded the Feds. The dollar is, you know, it moved up a little bit this week, but it's still down very low. In fact, I was calling for the dollar to eventually come down here to around 86.84, actually move a little bit lower, which would move the euro just a little bit higher. You can see the euro here is just riding the 50 EMA, riding it up like that, and challenging the 1.25. I don't believe Super Mario Draghi and Power Ranger Powell, our own Fed chair, they're going to let a gap exist too much between a subverted dollar and an increased euro. So we'll see them try and keep it in some kind of range. They do these monkey games all day long. British pound, if we look at the British pound currency, you can see here we're still moving up. We've got a poor man's bed on this thing, which means it'll probably come back down into that channel. But if I break it out, as you can see, right here, back down in this area here, I was saying we need to be long the British pound. It's just not going to stay down this level. This was just unheard of levels down here. And that was just a higher prob macro trade to stay long the British pound. So we got into it back in this area down here, made some money on the trade. But I do believe the pound is going to stay in this relative upside vector, which would push it back down into the channel. So I wouldn't go long the pound now, but if it comes down back inside this channel, clearly a little bit more of a pullback, I'd be more interested in taking it to the long side. Okay. Now, looking at gold, I have said this again and again and again. I am not ready to go long gold yet. You can see how gold is chopping a good deal. Now, I've left these on my screen up here. If you look at this on the upside of the screen, right here, I've got the 2017 high, 2016 high, 2018 high. So there's a lot of high prices going back to 2016. It's going to take a dynamic shift in the market environment and sentiment to move gold through this area. For now, we're in this upside down range. And you can see here, if we can move down to the 1300, I may be at that time a little bit more of an interested buyer. Once we get down into this area, which by the way is where we opened for 2018, around 1305.30, I'd be more of an interested buyer. Right now, I'm not. Okay, so that's a little bit about gold. Silver is about the same in this area here. It finished up just a little bit, but we're in this symmetrical triangle, which is longer term. If I really step it out, you can see what I mean. Let's just really step it out, right? There's the symmetrical triangle like that, right? Let's put it on a weekly so it's not quite as, I got all my indicators in the way on this thing. Let's move it out here for you guys. Here is the symmetrical triangle right here on a weekly chart. We're going to bounce out. Now, the odds, the technical pattern would suggest a break to the downside. I suspect what this is doing is setting up for a break to the possible upside. But we're going to see. We're going to follow the price action. When it does break, I think it's going to run pretty good. We've been winding up on this thing since the summer of 2016, and we're just, continually winding in and winding in. And the crosshair shows the summer of 2018. So that would be a 2-year wind up and then the pitch, which could move silver up to 2021 area, maybe the 2016 high, which is the pivot point way up here. And that would be a nice run. And you can play it with SLV or options in the silver market or silver itself. But that's kind of what I'm looking at. And then remember, when this breaks out here in silver, then you're also going to get a breakout in gold. All right. So, and looking at gold on a weekly chart, because we'll step it back a little bit, it's not quite as pretty. All right. It's just you don't have that same pattern on gold as you do on silver. All right, you've got this upsloping trend line here, which I think will provide support and where we may bounce off of. But we've got to clear this prior pivot here made in 2016 high price to really get some lift on gold. Okay, I mean that's kind of what I'm looking at here on that thing. So that is where we're sitting with gold. Now, oil, energy. Oil is getting closer to a fair market value here, at least for now. You can see here where we've been chopping, going all the way back to the past couple of 2 weeks in this range right here. It tried to make it up over 66, got pushed back down again, and we're sitting down here right around the 65 area. I think 64, 63 will provide nice support for us, and then we'll kind of see where we want to go. Okay, there is a risk premium built into oil because if Trump backs out of the Iranian deal, that's going to take some oil off the markets, and that will have a tendency to be bullish oil. And if we punish Venezuela with their upcoming elections, which were pushed from the end of April to May, that's also going to take some oil off the markets. And that'll also be an upward shift in the oil markets. There is a risk premium in oil right now, just a few dollars a barrel, I guess. It's just a guess, so it's hard to project what that risk premium is really worth. But there is a little bit of a risk premium built into the price of oil. For now, the 64.24, which is the prior pivot high made on 226, it looks like a hold-off point for oil. And then gasoline, I said before, that was a lot more bullish than oil. Look at that. And here's gas. We came up and then we just blew right through this thing here. So I've been more bullish gasoline than oil right now. UGA is the ETF to play, Uniform Golf Apple. Or if you've got a little bit more money, you can play in the gasoline futures market. Okay. There are things happening in the ag and the soft market, primarily with cocoa. I had talked about this breakout in cocoa. Cocoa had one of the best quarters of any market here. Now let's back it out and I'll show you guys. I was forecasting for quite some time. And if we look at this is a weekly chart, guys. And we were in this range for cocoa going all the way back to beginning of January of 2017. And I said, once we break out of this range, which was right around the 26th of February, cocoa just took off. I mean, it just ran hard, right? And there were several potential buy points in cocoa. Now we've broken out here. So there were some really interesting plays in the softs market in the cocoa futures, okay? And then there's some things happening in the meats and in the grain market where we've been heavily trading the grain market back in 2015, early 2016. We haven't been into it active now, but we're going to come back and take a look at it as I think it's going to present some opportunities. All right, everybody, that's pretty much where we're sitting now. Have a really great, happy Easter weekend for everybody that observes the holiday. Meanwhile, just relax, rest, spend time with friends. For those members, we will have our session Sunday night. Weekly Market Watch. If you're not a member, I highly encourage you to come in. We got 2018 is going to be, I think, even more interesting than 2017. It's going to be more of a trader's market. And then we're going to go into 2019, which serves up a ton of surprises. So everybody have a great weekend, and I will see our members this Sunday night for our weekly Market Watch. Take care, folks. Ciao.